We journey back to around 2000 BC. As farmers eagerly awaited their next harvest, they faced a dilemma how to ensure a constant source of food. They had two options: either turning to merchants who traveled through cities carrying grains, or building grain reserves to store their surplus harvest. However, individually storing a large amount of grain was far from practical, so around 300 BC in Ptolemaic Egypt, the state provided centralized granaries whereby farmers could deposit their grain, and whenever they wanted, they could withdraw their grain from the grain banks at a grain fee. Some scholars claim that the Egyptians even allowed transfer of grains from one account to another without grains leaving the granary. As the world moved from commodity money to coins and precious metals, the need for secure storage grew. The wealthy stored their precious coins and jewels in the basements of temples because they were seen as safe and secure with the presence of priests and armed guards. But this attracted unwanted attention during times of war. Julius Caesar introduced a new twist by allowing land as collateral for loans because noblemen with land passed debts onto their descendants until either the creditor's lineage or debtor's lineage died out. The Middle Ages witnessed the growth of banks due to two factors. One, the need for safe storage and credit facilities for trade. And two, wars and campaigns required substantial financial backing. And then in the 1770s, a Scottish economist by the name Adam Smith advocated for a self-regulating economy, empowering moneylenders and banks to limit government involvement in the banking industry. The United States of America emerged with banks each issuing its own distinctive banknotes as there was no common currency. However, this financial landscape came with a catch. If a bank faltered, perhaps through unfortunate events like a robbery or mismanagement, the banknotes they had issued became mere pieces of paper, rendered worthless. The first Secretary of the U.S. Treasury, Alexander Hamilton, established a national bank to protect these banknotes by accepting member banknotes, gradually creating a national currency and a secure system. Merchant banks, serving corporations and high-net-worth individuals, rose to power, amassing enormous influence into the 1920s, while common people were served by the lesser banks that still struggled. In the early 1900s, risky investments from these banks resulted into a bank run, leading to the bank panic of 1907. J.P. Morgan, the then head of the merchant banks, tried to salvage the situation by convincing major players in Wall Street to inject capital into the banking industry. The Federal Bank was then formed. The U.S. government controlled the banking industry, resulting in stern policies slowing down world trade and almost 9,000 bank failures between 1929 to 1933, the Great Depression. Interestingly, World War II's financial demands fueled mergers and a global outlook for banks. The confidence in the banking system grew. Banking services reached the average citizen, marking the modern era. The post-war world welcomed the IMF and the World Bank at the Bretton Woods Agreement, 1944, that aimed at creating a more stable and prosperous global economy. Central banks regulated commercial banks by enforcing policies that included special directives restricting banks from lending, and even mandating banks to keep a certain ratio of their total deposits in liquid form so as to ensure they are able to pay off withdrawals, creating confidence and transparency between banking institutions and individuals and corporations with whom they conduct business. As we entered the 21st century, technology and the internet revolutionized banking. Online and mobile banking became the norm, changing the way we interact with financial institutions. The evolution of banking has been an incredible journey. Stay tuned for more financial insights here at Almost Everything Money. Subscribe.